There are exactly 3 phases the market moves through every single day, and 90% of traders completely miss them. I'm not talking about complicated indicators or fancy algos, no. I'm talking about something that's been right in front of you this whole time. Now, look at this chart. I know, you used to see something like this. High highs, high lows. This is what you were taught. But forget about it. Forget about it, because we are not going to discuss these 5 great concepts everyone knows about. Instead, I'll teach you the auction principles you've never heard of, trust me. What you see right now is the true and the only market structure. I wish I knew 10 or 15 years ago. So, the first and the main phase here is balance. This is it. This is the balance. It all starts with an impulse. Yes. Then we see a fix formation. Fix forms when the participants of the market decide to close their positions, partially or entirely. In this case, these were buys and they decided to close their positions. This is why we see a fix formation. Then we see a counter movement, and then we see an inertial trade. An inertial trade is a trade taken in the same direction of the previous movement. And so this is like 99% guaranteed trade that you can always trade. If you can identify the fix formation, it means you will be able to identify an inertial trade. All this is the first segment of the balance. Yes, the balance itself has 3 segments, 3 main segments. And the second segment of the balance is the formation of the responsive activities. Responsive activities. We see seller's responsive activity and the buyer's responsive activity. And this is the second phase of the balance. And the third phase of the balance is, in this case, this is the middle level reinforcement. Middle level reinforcement. So the participants of the market has decided to reinforce this middle level, and then we see repositioning. Repositioning of the balance. Reposition of the balance is an impulse outside the boundary of the balance. Outside the boundary. In this case, the upper boundary of the balance. Then the next step is an initial fill. An initial fill is when, in this case, buyers just initially fill their positions, and that's it. No need to overcomplicate everything or overthink about it. Then we see retest and then move continuation. So this whole thing is a balance, okay? And this is the first phase. The second phase in the auction, if we talk about the auction theory, the second step is repositioning of the balance, and then move continuation. So another imbalance, another impulse. This is imbalance, and another impulse is an imbalance. This is what you usually used to hear when people speak about the auction theory. Then the next phase is the transition phase. Transition phase. This is where we analyze the market and decide whether a new balance is going to form, or it will be just a local balance, or it can become a volatility. So the first step is a balance. The second step is an imbalance, which is a new impulse. And the last step is the transition. So all in all, in general, the auction structure, the market structure, has 3 main steps: balance, an imbalance, and a transition phase. 3 phases, 3 steps. And we'll talk about the balance in more detail today and in the next lesson. And in my 10 years of trading, believe me, nothing, and I mean it, nothing, has been more valuable than understanding these free auction phases and understanding them the way I just showed you. It's not just a balance, it's not just a consolidation or a rotation like you used to hear. No. As you can see, the balance has a complex structure. Now, I strongly encourage you to watch this video till the very end. This is a base. Nothing would work out without a base. Nothing. In this lesson, I reveal the true and the only market structure you need to deeply learn. By the end of this video, you'll understand exactly how the market moves. I'll show you examples with the free auction phases, and if you do the home tasks, yes, along the way I'll be giving you home tasks, and I strongly recommend you to complete them. I'll tell you why this approach reveals the true market structure and shows exactly where institutional activity shows up. I'll explain to you the cluster volumes and the volume profile so you can read the market structure more precisely. I'll also give you a simple framework for finding just one to 3 high quality trades per week. Yes, per week, not per day, you heard me right. We're here not to overtrade or overthink or overwhelm ourselves. No, we're here to learn the real trading. Trading is much more simpler than you can even think of it. For years, I was jumping from one strategy to another, hunting for quick wins and quick money. I entered trades without 100% understanding what I'm doing and why. I had some winning days, but then the market like ate everything it gave me. It just took it back. And I used a ton of indicators trying to make each trade as perfect as possible, but nothing worked. My charts used to look like this. Instead of analyzing the clean price, I applied indicators, every possible indicator to show me support, resistance, trend lines, moving averages, top chart indicators, bottom chart indicators like RSA, MACD, stochastic, Bollinger Bands, and all sorts of those indicators. This is how my charts looked like about 10 years ago. To be honest, the main problem here is laziness. Most traders become, and this is understandable, most traders start trading trying to find quick wins instead of going deeper into the market structure, into trying to understand everything, how it all works. They try simple things and think this could work, but it never works. Now take a look at how my charts look right now. They're clean and precise. At the same time, I have everything I need here. The price, the volume, and the volatility. This way I see the big picture. I see the market structure, DNA, and the gears I need, the volumes, the cluster profiles, and the volume profile. That's all I need, nothing else. This helps me to identify the easiest trades possible throughout the week. The easiest. By the way, I'll teach you how to find a point of no return. When you can find those easy days to trade, you'll also be able to find a point of no return. Like, for example, it happened here. Here. It was a point of no return, and it was an easy, very easy and comprehensive day to trade. Okay, let's move on. In my system, we analyze the 3 W's. The first W is what? Here we analyze the context of the market. By the context, I mean the weekly, daily, 1 hour, and the 15-minute time frame charts. The second W is who. When analyzing the context, we identify the big players, institutions, hedge funds, banks, etc. We identify how big they are, so we know for how long to follow them. And the third W is where. When we have information about the context, the big player, we look for a perfect trade during a week. We align all the clues we gathered with the previous day analysis. I mean the volatility map, the closure, the task assigned to the day. Yes, we also assign tasks to the days and make assumptions on where exactly we can take a trade. When you understand the market structure, like I do, there is just no place for any hesitation, for any expectations, for Nothing like that. With the W free flow approach, everything changes. You will trade with absolute clarity about market direction. You'll focus on quality over quantity. Just 1 free precision trades per week. You'll know exactly who rules the market, buyers or sellers, on any given day. You'll pinpoint precise entry levels based on volume and price interaction. You'll develop the ability to predict high probability days to trade each week. Let's quickly take a look at the common approaches. So, James Dutton, the market profile. He introduced value areas and auction structure, but he missed the critical multi-time frame context. Stadelmeier, the father of original market profile, yes. He brought volume-based levels, but most traders used fixed shapes instead of understanding actual market structure mechanics. Wyckoff, smart money concepts, yeah. Great for understanding accumulation and distribution phases, but lacks precision for day trading like I showed you. Yes, balance is accumulation, imbalance is a distribution. Then we see another accumulation, another distribution, and so on and on and on. But here in my system, in W3 flow system, we see everything. It's just an evergreen system that is repeatable, and this is the beauty of my approach. So all these free systems, of course, they have value, but none give you the complete picture in a structured, repeatable way. The W3 Flow framework does. In this program, we'll move step by step. And now we will start from the fundamentals of the market structure mechanics. As you already saw at the beginning, the market moves in just 3 phases. Balance. Usually you call it a consolidation or a range, like I already said, and price moves sideways, looks like buyers and sellers agree. Looks like. Further on, I'll explain why I just said looks like. Imbalance, impulse. One side takes control, price moves aggressively, and then we see a transition to a new balance. So, balance, the war zone, yeah. Usually they say that the balance is the market phase when buyers and sellers find fair value or find an agreement, but it's just half true. Every balance has a complex structure. While it may look like an agreement between buyers and sellers, it's actually not. It's a war. You heard me right, this is a war, where we need to look for a winning side. That's why we'll gather all the clues possible to understand who rules the market, to understand when the next phase can happen, to understand who to follow, and when exactly to take a trade. The market always shows when it's ready to move further. And this is an imbalance phase. A new impulse. It happens when the winning side, buyer or seller, is clearly defined. The imbalance phase is the most easiest phase to participate in. The days are clear and mostly transparent. And to be able to identify this phase, you need to be able to understand the market structure, the balance structure. The balance structure, especially the second and the third segment I showed you at the beginning. Once the market reaches the price where another side, buyers or sellers, can be interested, a transition to a new balance happens. And when it happens, we saw volume accumulation, counter-directional volatility, we see speed and reaction. And when we see all these, we can define potential levels of a new balance forming. We can take an inertial trade, define our conservative and aggressive trades, depending on what style you prefer. When we have this information, when we understand the true market structure, the whole trading paradigm just shifts dramatically. Now, when you hopefully understand the market structure basics, let's take a deeper look at the market structure and auction principles. Instead of just reading all these auction steps and definitions, I'll draw everything to you so you can see it. All right. It all starts with an impulse phase. Impulse. Before we see a balance, the first segment of the balance formation, there is always an impulse. Remember it. A balance cannot be classified as a balance if there is no impulse preceding it. Okay? This is actually an impulse is actually an initial auction step. Everything starts from an impulse. Once again, please remember this. Before a balance, there is always an impulse. Okay. Then what we see next is the fix formation. A fix is a buyer or seller reaction at the market's high or low, shown through key statistics, volume, volatility, timing, based on time frame. This is a fix. And as I already said it, to put it simply, fix happens when the participants of the market, the institutional traders, close their positions entirely or partially. This is why we see this counter movement. Fix forms the boundary levels and helps to identify an inertial trade. Just like that. An inertial trade is a trade in the same direction of the previous movement. And as I already told you, this is one of the guaranteed and easiest trades. Inertial trade. All right. Then this is the first segment of the balance. What happens next is we see the formation of responsive activities. All right. We see two responsive activities from both sides, the seller's responsive activity and the buyer's responsive activity. And when one of the sides takes control over another, the third segment forms. And it can have actually several types we'll discuss in a separate lesson. For this example, let's present it like this. So this is the third segment of the balance. In this case, this is the mid-level reinforcement, and these are rotations, push-through rotations that push the price beyond the balance. And then the next step, let's actually mark them here. Push-through rotations. After the third segment, we see repositioning. A phase where a new impulse happens, usually with high volume and volatility and breaking past a key level. The key level of resistance was here, the upper boundary of the balance. All right? Then what happens next is an initial fill. Initial fill happens when the big player either closes some positions or gains new ones, which in return creates a counter-directional move. Then the price accumulates some more volume and we see a new impulse. And this is a move continuation. And this move continuation is supported by the balance and retest volumes, all right? And then we see a new fix, potentially a new fix formation. And here we can have a local balance, that accumulates some volume for move continuation, or it can be a reversal balance. But we'll discuss all these things in the second lesson, not to overload your mind. Yes, I'm also taking care about your mental health. Transition phase. All right. So this is what I call the DNA of the market structure. This is it. This is the market structure, the fundamentals, the base. This is all you need to understand. Once again, let me go through everything just once again. Any balance starts with an impulse. We can't classify any consolidation or rotation a balance without an initial impulse, all right? Then we see a first phase of the balance, which consists of a fix and an inertial trade. A fix forms when the participants of the market close partially or entirely their positions. This is why we see this counter-directional movement. Then we see an inertial trade. An inertial trade, it's inertial, that's why it's called like this. This is a movement in the same direction of the previous movement. And this is like almost 100% guaranteed trade. Then, and this is the end of the first segment of the balance. The second segment of the balance can consist of one or two responsive activities. It's not necessary to have two. One is enough. But at least we need to see just one responsive activity. All right, and here we classify and identify everything, the behavior of the price, the volumes, reaction, timing, everything. As I said, we'll discuss all this in more deep details in the next lesson. Then we see the formation of the third segment of the balance, which can have different forms. In this case, I showed you the middle level reinforcement when we have some rotations on the middle level and then push through rotations that just go beyond the key level, resistance level, the upper boundary of the balance. And then we see a new impulse, which is repositioning. Then we see an initial fill. An initial fill happens when institutional traders initially fill their positions. They can add some volume, add some contracts, and this is why this movement happens. Then we see retest. The price accumulates some volume again, and then we see the move continuation until the transition phase. And during the transition phase, we see a new balance form. And this is it. This is it. For now, I want you to deeply understand all this. And I repeated it twice on purpose because my main goal is for you to understand everything as deeply as possible. All right, moving on. Now, let me actually, here you see an example of the gold chart. Let me walk you through one another balance. This is gold. I'm showing you different instruments on purpose to show you that usually I trade ES, by the way, S&P 500. This is my favorite and the only actually tool I'm trading. So this is gold. What we see here, this is daily chart. We see an impulse. This is an impulse. Let me actually draw it. We see an initial impulse. Remember I told you that we can classify any range, any consolidation as a balance before we see an initial impulse. Then we see fix. Fix formation. Then what we see next is an inertial trade. What happens next? We see a formation of seller's responsive activity. Then we see a formation of buyer's responsive activity. Then what happens next? We see in this case the third segment of the balance takes another form. In this case, this is the responsive activity reinforcement because we can't classify it as a mid-level. Mid-level is somewhere here. And we can't classify this movement as a middle level reinforcement. That's why we classify it as responsive activity reinforcement. All right? This is the third segment of the balance. Then again, once again, Let me add text here. Then what happens next? Again, we see push through rotations. Here, push through rotations. And then we see repositioning, all right? This is the balance, repositioning. I usually mark it as RP, yeah. And then we see an initial fill, retest, and finally move continuation. And then we can see a formation of a new balance, etc. But for now, take a look at this balance again, and I don't think I need to repeat the whole structure again. I recommend you to listen again and again this video, to watch it again and again. This will help you to create a structure in your mind, to create a structure in your head. This is why I'm here. Once again, just quickly, an impulse, fix, inertial trade. This is a first segment of the balance. The second segment of the balance can consist of one or two responsive activities. In this case, there were two responsive activities. The third segment can take different forms. In this case, this was responsive activity reinforcement and plus push through rotations. Then we see repositioning of the balance and initial fill, retest, and move continuation. This is the market structure DNA. Let's move on. Okay, now take a close look at this picture and try to do it on your own. Try to identify an initial impulse, fix, an inertial trade, responsive activities from both sides, the third segment, repositioning, an initial fill, retest, move continuation, and transition to a new phase when the fix forms. Try to do it on your own. Pause the video and make the exercise. Did you pause? Did you pause? Okay, I hope you did. Let's move to the next exercise. The next one. The second exercise. Do the same. Try to debug everything here. So before, in the previous slide, I gave you an image. And here I give you an image of a real world example. Real world scenario, real world balance. Try to debug everything here, exactly like you did with the previous example. Identify an impulse, fix, an inertial trade, responsive activity, bias, sells responsive activity, the third segment. And don't worry if you make mistakes. This is absolutely okay to make mistakes. Absolutely okay. Again, pause the video and complete the exercise. I hope you did. Moving on. Now, let's talk about what really powers the market, the volume. So I'd never say that the price action does not work. It works, and it works pretty good, especially when you combine it with the key levels of support and resistance and top-down analysis. But even Sokuhoma, I hope I pronounced his name the right way, the god, they usually call him the god of candlesticks, used market volume to trade. And volume is the best fuel for the market. Like it happens with cars, the market needs some fuel, some gas to move up and down. Now actually, let's go to the charts. Let's improve our charts. This is what you get used to. Candlesticks, right? So first of all, let's change the candles to cluster profile. Just like that. So in many platforms, there is actually a setting that allows to show candles. Let me show you. I strongly recommend you not to do so. because candles with volumes together create a big mess. Just trust me, I tried it. Instead of helping each other, volume and candle signals are often in conflict with each other. So this is why I'm removing candles from here and recommend you to do the same. You need to get used to this. Now the current chart, this is S&P 500, looks like this. Let's apply some filters weekly. I already know the numbers. That will be easy for me. All right. This is it. Looks like yes. Now, if we zoom in, we can see volume accumulation at certain places. This gives us more information about what's going on the market. We can zoom in more. See? And we'll see the exact number of volumes accumulated at a specific place, like here. So this is one of the several ways to represent the volume horizontally in each time frame. By time frames here, I mean a single bar or a candle. Now, another way to represent volumes horizontally and show us the bigger picture is the volume profile. Let's add it to our charts. Just like that. My volume profile is already set up. I don't need to change anything. So now we can see a bigger picture. We added a daily volume profile which shows us the value area for each day. And this is it for the volumes. To analyze the volume impact on the market, all we need is the volume profile and the cluster charts. We see the cluster charts, we see the volume profile. This is the value area. I'll tell you more about it a bit later today. And we use this setup for every time frame, with the only difference that for the higher time frames from weekly to 15 minutes, we just use a general volume profile, not a daily one, to be able to see the volume distribution throughout a certain period of time. In this very example, let's go to indicators. I use the daily volume profile so we can analyze the market under the microscope throughout the day. Okay? Once again. So you have no more questions regarding these two. First of all, remember this. For each chart, we use cluster profile plus volume profile. As I said, for the higher time frames, we use general volume profile. It's usually called volume profile, like you see here in indicators, volume profile. And we use the higher time frames for analysis, okay? And for precision, for the intraday trading, we use a separate chart. I use 1 minute and 30-minute time frames with a daily volume profile applied to it. In this case here, you see an image of a 30-minute time frame. My 1 minute time frame looks a bit different. Let me actually show it to you. I hope you can see it. This is my 1 minute time frame chart. Yeah, I use it for precise entries. This allows me to see all the pullbacks, all these little breaks, pullbacks, retracements, everything. Okay? I want you not to confuse volume profile with the daily volume profile. Here we use, once again, daily volume profile for precision, for our entries, for intraday trading, and for every other time frame, like weekly, we use just general volume profile. The first one, volume profile, here we see the, volume profile, daily chart. We also see volume profile, Hourly time frame, volume profile, 15-minute time frame, just volume profile. And for precision, I use the daily volume profile. This is for taking intra-day trading. Okay? I hope this is clear. So the volume accumulation at certain areas allows us to see dynamic support and resistance levels throughout the day. Let's go back to the charts again. Let me quickly show you those. For example, like here, we see some volume accumulated here, we see a reaction here, we see a reaction here. It was a resistance. So this volume accumulation created a resistance. Then we see this level. First it acted as a support, then it became a resistance. You see? Once again, we see this big volume accumulation, and then we see a reaction here. So, as you can see, these filters I applied previously just help me to quickly grasp the main idea of what is happening on the market. These are dynamic levels, they are not key levels. I'll walk you through the difference between the dynamic and key levels in the separate lesson, okay? This is just to show you the basics, how it all works. The volume profile, the one we apply to a specific time frame, daily for 1 minute chart, general one for all the other high time frames from weekly to 15 minute, allows us to see the value area. Let's take a look at the example. The value area shows us, this is the value area. This is the value area here, okay? The value area shows us 70% of all trades that were taken during a trading session. I always stick to this number, 70%, and recommend you to do the same. This is a classic approach and it works just fine. No need to overcomplicate things or reinvent the wheel. The value area has 3 significant points to pay attention to. Value area high, value area low, and the point of control. Value area high is the top of the range. If we see a seller's activation here, we call it a responsive activity. Like it happened here. This is a responsive activity. Okay? The value area low is the bottom of the range, this line. And if the buy activates here, we call it an initiative activity. Exactly like it happened here, initiative activity. Now the point of control. Point of control is the price level where the highest number of contracts were traded during the trading session. This is the most accepted price. So what's the value of the value area high, point of control for us, the day traders? Actually, these levels are the most misunderstood levels in trading because many people use these levels as key levels for decision making for the next day trading, which is absolutely wrong. Let me be clear here. Value area low, value area high, and the point of control are just levels, and they allow us to gather clues for the next day. Never ever use them as a single clue for taking trades the next day. Now let's take a look at the example. So, for example, if the day closed above the value area, the overnight volumes are clearly positioned as buying volumes, and the volatility map indicates the clear buy win. It means we buy the next day with 80% probability. Like it actually happened here. What do we see? This is actually a capture volatility day. Not the best one, but this is we will also discuss all the types of the days in one of the lessons. The closure is positive. It's positive. See the closure above the value area. Okay, the overnight OV, these are overnight volumes, are clearly positioned as buying volumes. All right, so it was Wednesday. Let's take a look at another day. This is the previous day and this is Thursday. We had a good opportunity to buy early. The pre-market was in range. Yeah, this was just a range and there was not a hint of a negative. And you could easily take a buy trade here. At the same time, you might have been hesitant because the early entry happened just below the previous day high here. You can see it here. As you can see, this was a resistance at that time. And for me, yes, it could be uncomfortable to buy exact under the current resistance. It was a dynamic level, yes, but still. So what we can do in this case, simply shift the time. Shift the time. In this case, to the second half of the day. Okay? At 12:30, we take the easiest possible trade. No hesitations, no emotions. We found a point of no return. And this is the beauty of the whole system of understanding the market structure like I do, because when we know the timing, when we know that we can shift the timing, when we know the time periods we can take trades, this is crazy. This is crazy. I wish I knew this before. Okay, let's move on. So these processes don't always work like you just saw, like it happened here. Everything looks perfect, like the buy has won. We see a volatile day with a clear closure up. Closure up. We see this volatility outside the value area. Okay? The day rotated the first half of the day and then positioned all these gathered volume as a buying volume. The overnight volumes are positioned neutral. Nothing negative here. Everything looks perfect to take a buy trade the next day, right? Ron, what is missing here? Think a bit. Think for a second. What is missing here? The context. It was Friday, the end of the week. Oftentimes, the big players just close their positions at the end of the week. This is especially true when we speak about swing traders. Swing traders trade the 15-minute auction. See what happens on Monday. This is Monday. This is our previous day. There was not even a hint of a struggle. A clear sell without any hesitation. You may ask why. And this is a valid question. The answer is the context. You can't skip it. You can't rely only on one clue. This is what I'm going to teach you throughout the whole W Free Flow program. Take a look at the 15-minute auction. This is 15-minute auction. As you can see, we had a balance. We had a balance here. Okay? And on Thursday, the balance was repositioned. The balance was repositioned. And our Friday, where we saw that beautiful closure up, just set the price up for a retest. Here was repositioning, clear repositioning. Then the day brought the price up for a retest. And what happens after a retest? Remember? The move continuation. Exactly like it happened here. The move continuation. Okay. This is how the whole process works. We take note. Yes, now I'll walk you through how the whole process works. We take note of the current situation every single week. We gather all the evidence from the weekly, daily, 1 hour, and the 15-minute time frame charts. And here I want you to understand one very important thing. We do not set our expectations on the market. Never. All we do is gather clues the market gave us, nothing else. We summarize all the data we gathered. we make certain conclusions. We forecast the next week type. I'll show you all the types of the volatility possible in one of the next lessons. We predict the rhythm of the week. By the rhythm, I mean certain days when we can take a trade throughout the week. For now, you won't believe it, but it's possible. We set the priority for the week, buy or sell. We set the certainty level for the week. It can be 1, which is an impulse, everything is easy and decided. It can be 2 plus, everything is almost decided. 2, a good possibility to take a trade. 2 minus, we face some uncertainty on the market, and therefore we are very careful with our trades. It can be 3, we stay on the fence and wait for the clarity. We set the then what we do next, we set the levels to take the trades from. Once we have the weekly prediction, the weekly analysis, we stick to it and do analysis of the market on a daily basis. Here, every single day from Monday to Friday. From Monday to Friday. We analyze each day after its closure. We take note of the volatility, day type, the closure. We align the previous day with the 15-minute time frame, keeping in mind the context of the market, the weekly analysis we made during the weekend. Okay? Then we keep looking for the clarity days according to the rhythm of the week, the clues we gather to take the easiest trades possible. It looks like. Take a look at this document. So what we do here? Now pay attention to this part. This part. Pay attention to this part, which is assessment. Fuck. I just don't see this circle. Now pay attention to this assessment part. Here we evaluate the current market phase. We keep in mind our weekly market structure. Analysis, and for the intraday trading, we align everything with the 15-minute auction. We assess the previous day's character, the price and volume relationship, and get a complete picture of the current market structure. This directly connects to the first W in W free flow. What? We assess the market context before anything else. Now, pay attention to this part. Analysis. Not paralysis, just analysis. So yeah, step 2 is analysis. When we assessed everything, we dig deeper. We analyze the current market activity and align it with the high time frames, okay? Then we look at the big players, trying to find out what they're doing. Then we look at the big players, trying to find out what they're doing. We evaluate the whole market structure and determine who is strong right now, the buyer or the seller, to know who to follow exactly. This aligns with our second W. Who? We identify the power. We identify who rules the market who rules the market right now. Okay? We identify who rules the market right now. Now, pay attention to this conclusion part. Conclusion part, okay? Here we personalize everything and make our trading decisions based on all our analysis. We determine our trade direction. What are we doing? Are we selling or buying? Like I told you, we do not create a mess in our head like some traders do. They sell and buy on the same day, and this, in my opinion, it creates a huge mess in your head, and this is like an impossible trading for me. Then we identify precise entry and exit levels, and we develop a timing and execution plan. And this completes our framework with the third W, where we now know exactly where to enter for the highest probability trades. By the highest probability, I mean 80% guarantee, and sometimes even higher. Now, let me actually walk you through the day I traded. So, let me show you this day. Let me find it quickly. Yeah. Is that? Friday. Let me do. All right. Here is that day I analyzed. Let's just read what is written there. All right. That will be easier. Thursday has created the necessary volume to push the price to at least 56. Yes, this was a volatility day. We see a closure down, all right? A closure down, not down. This is neutral minus actually. This is below the point of control, but still inside the value area. Yeah. And there is no bias activity. These spikes mean nothing. They literally mean nothing. There is no volume, there is no huge reaction, nothing. All right? Context. Hourly, I stick to hourly time frame. What we saw on the hourly chart, the deep retest. Let me context. Yes, hourly chart, the deep retest plus repositioning, statistical inconsistency may potentially create complications for selling, but this is very unlikely. Now let me show you what happened on the hourly chart. Here, let me find that day. It was here, I remember. It was here. we had a balance, then we have a repositioning of the balance when we have an initial fill and a deep retest. All right. So this repositioning was statistically incorrect. This is what I indicated in my trading plan. There was not a hint for any hesitation in seller's activity. This is what I was talking about. Okay. The task, Friday's tasks. As I said previously, every day has a task. Finishing of the sales, nothing else. So the tactics, an early sell at 57.60. 57, like here, yeah. Like here. I assume that the price could go up to this level. It didn't happen. My prediction was it would be an easy trade, and it was. But what happened here? Let me explain. The pre-market already gathered volume below the value area of the previous day. So this day showed that everything is ready, everything is prepared for the sell move, and there was nothing to think about. And the market opportunity, yes, was high. And that's it. That's what I did. Let me actually show you the trade itself. Yeah, this is the trade. This is the trade I took on my real account. Yeah, this is the 15-minute chart on TraderWeight. Here I entered and I hold it till 56.44. I hold it long enough, then closed on a predicted level, and that's it. So the trading itself shouldn't be complicated. It shouldn't create any emotions, any unnecessary thoughts in your head. No, it should be simple. Guys. Let's move on. So let's go over what it takes to get really good at this. I know, I understand you're already tired. If you get to this point, I know you are tired, but I want you to know this. Trading is a skill, and it requires consistent practice and focus. What I recommend you to do, pick just one approach. I recommend you to stick to W free flow method and stick to it for at least a year. Use a single instrument. I recommend you to use S&P 500, and only after that should you draw any conclusions, okay? Most traders fail because they constantly jump between strategies, never giving any approach enough time to work. Commit to this process. If you follow me and my approach, you won't need anything else. Literally, it just takes time to click. And when it clicks, everything starts to change. I know your question. You want to know when it clicks, yeah? On average, it happens in 6 months. It all depends on your previous experience and skills, on how much mess in your head right now is. If you are just starting out and know almost nothing, you are like a blank slate. Then it may take 6 months before you can trade with real money. But if you already struggled for years, tried like everything, it means your head is full of garbage, and creating those new neural connections will take more time. This entire program, this entire program is 100% free. I don't sell courses and never will. And I don't hide anything, because I believe financial market education should be free and accessible to everyone. No other way. For now, I recommend you to do this home task. First, try to find as many balances as possible, at least 5. Make sure to identify the balance and imbalance phase correctly. Remember that there is always an imbalance phase, an impulse before the balance. What is an impulse? This is a directional movement that has very little retracements, pullbacks, straight directional movement. If there is no impulse, it means there can be a balance after. It's just a volatility, directional volatility, nothing else. If your platform allows to do so, apply the cluster charts and the volume profile. Try to find patterns in the price movement. Use different time frames. Look for balances on weekly, daily, 1 hour and 15-minute time frame charts. Overall, I want you to start feeling the market like an auction, not just a set of candles and moving averages. No. By the way, make sure to remove all the indicators from your charts. From now on, we will use the auction principles. Following these principles, you don't need just indicators any longer. Clean charts, clean mentality. Now, before we wrap up this first lesson, remember these key points. The main three auction phases, balance, imbalance, and transition, form the foundation of all market movement because this is a true market structure. Volume also plays a critical role here. It reveals what price alone cannot show you. Trading with a structured approach like W3 flow removes any guesses or worries. And most importantly, commitment to one system is the path to profitability. Your profitability, not mine. Stop jumping from one strategy to another looking for a holy grail. It doesn't work like that. Trading doesn't work like that. The holy grail is you, your consistency, your commitment, and depth of understanding. Start analyzing the market like an auction, not just a set of candles and indicators. Believe me, my friend, my fellow trader, this shift can change your trading forever. So that's it. That's it for the first lesson, and I hope you've got some valuable insights into market structure, into the real and true market structure, and the volume and cluster profile analysis. Make sure to finish your homework before the next lesson. We will be talking about the balance phases in more details. And I'm here to guide you. I'm here to guide you every step of the way so you can truly grasp all these concepts as easily as possible. Take care. See you in the next video.